So I just opened a poor man's covered call. I figured I'd give you a full masterclass on exactly how to open, maintain, close, and hopefully profit. For those of you that have been following me for a while, you know this is getting serious because I've skipped the whiteboard and all my sloppy handwriting and I made a PowerPoint presentation. Let's dive into it right now. The poor man's covered call. So I promise down in the description, guys, I will leave chapter links so you can move forward and back, review things if you need to. But here is the poor man's covered call. It's using a LEAPS option as collateral instead of 100 shares to write a short call, which we'll call a covered call, to collect some sort of premium. And this premium we like to call income. Technically, it is called a long diagonal calendar debit spread. It's a mouthful. That's why we just call it a poor man's covered call. This can also be done with puts. So anything I say, like when I say we're going to buy a call, you can also buy a put. You can do the whole thing with puts as well. That's often a common question. And yes, I did recently make a video about how I hate credit spreads. That is still true. This is not a credit spread, guys. This is a debit spread. Let's knock out some quick vocabulary, guys. A LEAPS options contract. LEAPS stands for long-term equity anticipation security or securities. The S does not make LEAP plural. If you're watching a video and someone says LEAP option, okay, maybe they made a mistake. But if they say LEAP over and over, red flag, guys, run. Run for the hills. If you see LEAP in the title, and it's not a LEAPS, it's just such a pet peeve of mine. Maybe you can get down in my comments and just write LEAP, LEAP, LEAP. Yes, that will trigger me for sure. But guys, this is a LEAPS option, okay? The long call or put with an expiration of generally 1 year or more. Guys, when I say long, all I'm going to be meaning is buy. When you buy, you are long. When you sell, you are short, okay? And we want to go out 1 year. In my example, we're going to go out 3 years. And this purchase is going to result in a debit, right? When we buy something, we pay money. When you buy an options contract, you pay premium. I will also be talking about the short call, guys. This is the call that we are going to write against the LEAPS options contract. So generally with a covered call, right, we have 100 shares. We use that 100 shares as collateral, and then we write the call against those 100 shares. Here we are not going to own 100 shares. We are going to own the LEAPS contract. Short call meaning that we have sold an option as opposed to buying it. When I say short call, that means I've sold a call. Long call means I've bought it. These short options result in a credit. You get paid when you sell something. So we are going to buy a long call for a lot more premium than we are going to sell. So we have to buy, which is going to cost us a lot of money, but then we're going to get a little bit back when we sell. That's why it is a debit spread, because after the two transactions, we are still at a net debit. Premium is another word I'm going to use over and over again. This is just the value of an options contract, how much it's worth. This is different than the share price. This value is constantly changing. Constantly up, down. So I can show you a screenshot now. 5 minutes later, a minute later, it's probably going to be a little bit different. So this is the money that's collected or paid when we buy options or we sell them. And this value must be multiplied by 100 to get its true dollar amount. You should probably know why that's true already, but essentially an options contract represents 100 shares. So we need to multiply the premium value that we see times 100. Delta is one of the Greeks values that's really going to be important inside this trade, guys. I made a full video on the options Greeks. I think it's actually my most viewed video or my second viewed most video. I'll link that down in the description so you get a full breakdown of the Greeks if you need it. But this is how much the premium will change with a $1 increase of the share price. So the share price is going to continue to go up and down. This is going to affect the premium value of that option. If the share price goes up $1, we can expect that the premium will go up by that amount of delta. This is also used by many as a rough estimation of the odds that the share price is going to reach the strike price by a given expiration. And this helps us to assess the risk. That strike price, guys, is just also known as the exercise price, and it's a predetermined price that we get to choose in which the buyer of the options can purchase or sell 100 shares of the security or the asset. In this particular trade, guys, I am not going to choose the strike price by its actual price, more by its delta value. Expiration is just a future date and time that the option will be exercised if it's in the money, or will expire worthless if it's out of the money. In the money for a call means the current share price is just above the strike price. and out of the money if it's below, and we say it's at the money if the share price and the strike price are in the same exact spot or relative to one another, pretty close. And for a put, it's just the opposite, right? If you were in the money, the share price is below the strike. If it's out of the money, it's above the strike. All right, so here's a little cover my ass before we begin. You should be very, very comfortable buying and selling options. You should know how to close options. You should know how to roll options. You should understand that you can lose all of your money inside the option that you purchased. This should probably not be your first options strategy, right? You should probably be selling calls and puts for a pretty long time before jumping into the poor man's covered call. And you should probably just not trade options in general, because for most it's pretty risky and the risk probably isn't worth the return. Just being 100 with you. All that said, time to execute, execute, execute. Here are the 4 steps to completing a poor man's covered call. Step 1, we are going to buy a call. This call is going to be at least 1 year until expiration. The further out, the better. This gives more time for things to go our way, frankly. And when we close this option later, after a year, we will now be taxed as long-term capital gains instead of short-term capital gains, which is awesome. The next step we're going to think about is a delta of 0.8 or higher. So, as we just mentioned, this gives us roughly an 80% chance that the share price will stay above the strike price and stay in the money. And this also gives us the leverage of 80 shares of that security. And I'll break that down in full detail in just 1 second. So here's a screenshot of a call that I just purchased on the SPY. It has an expiration of 12/17/2027. So a little less than 3 years away. Today is Valentine's Day, 2/14/25. It has a delta of 0.83, so there's that 0.8 or higher. This delta had a strike of $545. Like I said, I don't really care what the strike price is for this particular strategy. I'm more looking at the delta, and then whatever the strike price is, it is. And the current share price, just for some comparison, right now it's trading for 610. I think we reached all-time highs today. And this costs a premium amount of $14,452. Now, Brad, that's so much money. Oh, I should do you could choose whatever you want. We'll talk about why I choose ETFs in just 1 second. I know this is a lot of money for a lot of people, but for some it's not, and we're going to talk about risk in just a second. When I said it's the leverage of holding about 80 shares of the security, here's what I mean. At a current share price of $610, 100 shares of the SPY would cost me 61 grand, back of the envelope math. Then, in a traditional covered call, I can write calls against those 100 shares that I just spent $61,000 for. This option had a delta of 0.83, so if the share price goes up by $1, then I get an $83 increase in premium. So it's like owning 83 shares, right? If you owned 83 shares and it went up $1, you get $83. 83 times the current share price, that would cost me $50,000 for that same amount of leverage. So I just bought it. I just bought $50,000, $50,600 for $14,452. And I can write the same covered calls against that LEAPS contract as I can owning the 100 shares. But Brad, this sounds too good to be true. We're going to get smoked. Let's see. Are there risks? Of course, and there's some people that have probably already been down in the comments section. Thank you so much for stopping by and leaving a comment. It really does help the channel. One of the ones we've probably going to see is, it's great until it isn't. Or my other favorite, it's like picking up pennies in front of a steamroller and all that other things. Guys, every investment has a risk, and it's our jobs to assess our own risk tolerance. My risk tolerance is not yours, is not your friends, is not your wife's, okay? Everyone has their own risk tolerance, and everything in life has a risk. Driving in a car has a risk, but we weigh the pros and cons of driving a car versus walking, and generally, okay, for most people, driving the car is going to make more sense. For many people, guys, this may not be worth the risk, and I fully understand that, but just because it's not for you doesn't mean it's not for everyone. Just before you just bash the whole strategy and like can't wait to get into the comments. Just, all right, here's some more risk. What are the risks? I don't even know if they're risks. I think it's just, what is the risk? Well, the security share price is not in the money at expiration. The value of that option goes to zero. You lose all of the money that you paid for the option. In this case, $14,452. $452. When you buy an option, you have a fixed max loss. That max loss is the premium that you paid for that option. Okay, so in this case, if the stock or the asset that I choose dives in price, I lose my money. I lose $14,452. Now, am I going to lose that total amount? Probably not, because of the calls, and we're going to talk about that. Also, we're hoping that maybe it doesn't dive all the way to zero, right? And maybe that option has a little bit of value. Even if it has $500, maybe I can get some of that money back. But the max loss is $14,552 in this case. Here's some ways we can lower that risk. Here's the analogy I learned when I learned about the poor man covered call, so I'd like to pass it on to you guys. This is a $5 million investment property. It's a beautiful house. If I had $10,000 in the bank, this would probably be a terrible purchase for me, right? It would make me very house poor. This would not be a good risk for me to take on a $5 million rental property. But if I had $100 million in the bank, it might make a little bit more sense. But just like with this LEAPS options, an investment property, right? Real estate has its risks. The day after I buy it, could this house burn down? It sure can. Could the housing market crash and it go from a $5 million house to a $1 million house, losing me $4 million of appreciation? Sure could. Could the renters destroy it? Absolutely. But even with all those risks and many more, does that mean that no one should invest in real estate? And the answer is no. Some should, some shouldn't. That's the same here. And I'm going to continue to use this house analogy because it just makes it a lot clearer for most people to understand. And here's kind of the upside against that risk that you need to evaluate. The house may appreciate in value as well as collect rental income to lower the initial cost of that property and maybe even one day produce some passive income. This appreciation and income makes it worth it for some people. But just as a reminder, you should probably know something about real estate before you buy that house. You should probably know a little something about options before you buy a LEAPS contract. So in our case, the LEAPS contract is the rental property. The covered calls are going to be the renters paying us rent. An increased market condition is going to be the appreciation of that contract. And a stock market pullback is the risk of the house burning down and going to zero, if we're going to compare the two investments. So you weighed all that risk and you've bought yourself a LEAPS contract. Step 2, we are going to sell a call and use that LEAPS contract as collateral. Expiration on this call is absolutely personal preference. You can do 1 month, 1 day. It's really personal preference, up to you. I like 30 days or so, right? And this aligns with the I like to collect rent every single month. So I will make my expiration roughly 30 days out. I know some people like to write weeklies. That's just a little bit too much for me to manage. At any more than 30, you start to lose income on time. So I think 30 days for me is just a personal sweet spot. We like to use a low delta based on our experience when choosing the strike price. The lower the better. So 0.2 is probably a good place to start if you're an absolute beginner and you don't really know how to maintain, or you're still learning how to maintain that short call. All right, this can increase as you learn how to manage things. So I'm never really going to go more than maybe 0.4. That's the really as high as I will go. But I also know how to roll, close. I know the risks and things like that. So maybe start nice and low and feel it out over time. So here's an example of a call that I wrote. This call has a 27 days till expiration, and its strike price was chosen with a delta around 0.41. So this is a little bit higher risk for that short call. If it was less delta, it would be lower risk. This will pay me $528 in premium and lower the net cost of the LEAPS. This is the rent that's going to be used to help pay back the initial price of that LEAPS contract over time. So here's really what I mean about the net cost, right? If the LEAPS contracts, the rental property, cost me $14,452 and the short call just paid me $528, there is still a net debit, okay? That's why this is a debit spread. But the actual cost that I paid for that LEAPS now gets reduced in a net form to $13,924. And every time we write a call, it is going to lower that till maybe one day we pay that thing off and we collect enough that we really didn't pay anything for the LEAPS. That'd be dope. Not only can we hopefully pay back ourselves using it, but maybe the LEAPS contract as well will appreciate in value as the markets continue to go up. and then we'll be able to sell that just like selling the house later on and collect even more income. That's like the ideal scenario. And that's also why I choose the SPY, because it's hard to keep ETFs down, especially over the course of 3 years. With a regular stock, oh gosh, who knows what could happen. So now that we've bought and sold the call, we must now manage that position. And this is so important, and probably the most important thing about the whole poor man's covered call. You must manage that short call and be able to manage it frequently. Now, the frequency in which you check in on this short call, it depends really on your expiration, okay? The shorter the expiration, the more you're going to have to manage it. This short call cannot get close to expiration. 5 DTE is really as close as I'll go. So if you're selling weeklies, that's why I can't sell weeklies. So I'm not going to let this thing get within 5 days of expiration. The closer expiration, the closer you are to getting exercised, things like that, especially if you're doing this with a stock that pays a dividend. Some people will exercise early to dividend capture. Like I said, I just don't like being close to expiration. It's kind of like if you're a boxer, you do not want to get to the judge's scorecard. You want to knock them out initially. So I want to have control, and I want that control to be way before expiration. You must close or roll that short call if there's any chance of it getting assigned. Assignment of that short call will blow up the entire trade. Now, closing and rolling options, I'll say it again, is something that you should be comfortable doing with before you buy the LEAPS. So many people get into the Discord like, Brad, I'm screwed. What am I going to do? I got this LEAPS option. I don't, like, please. Remember, you would not buy a real estate property if you knew nothing about real estate. Do not buy a LEAPS contract if you do not know how to manage options contracts. Your short call getting assigned is like the renters destroying your house, and then it goes to a value of nothing, regardless of how much it cost before they wrecked it. Every broker is a little bit different here, but generally, if your short call is assigned, your broker is going to exercise the LEAPS to cover that short call, and that's going to be at the strike price, not the value of the option at that time. So if that thing has appreciated a bunch, that LEAPS, and then your short call gets assigned, you are going to get that long call exercise, and you are going to lose all the appreciation value. Just like if the house goes up in value and then the renters destroy it, boom, it's going to tumble to zero. So now we've managed, and we might have to close the total position. All right, now here's what we're going to think about. Now, closing is also a personal preference. Here's some metrics that I like to use and I like to look at. I buy to close the short call when it's between 60 to 75% in the profit, or like I mentioned a second ago, 5 days till expiration, whichever comes first. Sometimes you will have to roll for a loss. Consider these maintenance expenses on your investment properties. They happen, right? If you have an investment property, sometimes you're going to need to put money into it. That's just, sometimes the roof leaks, sometimes the furnace blows, sometimes the refrigerator breaks, okay? Sometimes you are going to have to roll for a loss. The LEAPS option is going to appreciate in a better way than the profit you'll get from the call. So if you have a call and the thing shoots up way past the call and you're like, oh my gosh, I need to roll this thing for a loss, I can promise you that your LEAPS increased in value more than what you're going to pay to roll at a loss. Guys, sometimes you will have to roll at a loss. I'm going to sell to close because we bought to open my LEAPS when it is at 100% profit. If that thing doubles in value and goes up to 30 grand, you bet your ass I am closing that LEAPS option. If it happens tomorrow, I'm doing it tomorrow. If it happens in 2 years, so 100% profit is where I'll be, or less than 6 months of expiration. Once we're about 6 months expiration, I'm going to think about closing that and then probably opening another one. That's just the way I like to do it. You cannot close the long option if you have an open short call. So if it shoots up in price, you got to buy to close the short call, and then you can sell to close the LEAPS. To wrap this whole thing up, before I have a few more things to say, guys, this isn't for everyone. I would not do this with stocks. In my risk tolerance, they're just a little bit too volatile, so I like to do them with the SPY, and there's also a ton of liquidity. Also, there's a ton of volume, multiple expiration dates every single day in the SPY. That's just kind of why I like the SPY. I'm sure you could do it with a much more volatile stock with higher premiums. If that risk is your style, then go for it. You do not need to tell us in the comments all the way the strategy goes against your risk tolerance. Like, okay, we get it. It's not for you, bud. This presentation was just for educational purposes only, explaining what the poor man covered call is. It is not to persuade you to do it, right? If anything, I want to make you more comfortable in doing it, but I'm not telling you you should. This spreadsheet, this slide presentation, I'll make available to all my channel members. You can join that for, I think, $1.99 a month. And I will leave a link in the post where you can access this. All my trades in real time and full discussions daily are inside my Patreon. That is the first link down in the description below. And I will update this particular trade every single month for the next 3 years. So consider subscribing. Leave a comment if you learned anything or any questions that you might have about this strategy. Give the video a thumbs up because apparently the YouTube algorithm loves that sort of things. I will link a couple other videos here that you can check out that are kind of related to this. And I will catch you guys on the next one.